Reducing risk is literally the most important thing in retirement, man. Reducing risk to your investment portfolio. I don't want to say the most important thing. It's one of the most important things. I was working with this couple today who it's probably my fourth year working with them now. Hey, you guys, it's just fun watching people go into retirement. Just watching the stress level, just like the lady was telling me today. She goes, Josh, I can't. I don't have a stress, dude. I get to go hang out with my grandbaby, once a week because they live over there. I don't have to go in the office. And, she liked her job, but she was stressed out. She goes, it was so come home and, we couldn't make food for, we just pick up something and, because she was tan. And I said, they live in California. I said, it looks like you've been enjoying outside. She goes, absolutely. I'm out in the garden. I crochet. Is that the crochet where you hit the ball and that called crochet? I was like, okay. I know people still do crochet, but whatever. The little ball with a thing like that, and it's got the little pins. Is that crochet? Whatever. It's crochet, right? The hell is that sport called? Oh, I'm getting old. Anyway, be that as may, and you just see that, and the aura, the positive aura. And I talked to her husband and say, yeah, man, not they've been married for I think they said 37 years. I know they're kicking ass taking names, but it's just the stress level just God. I get people email me like this all the time. Blood pressure goes down, they lose weight, they're getting sun, on their the vitamin D. They're just out doing what they want to do. You know what I'm saying? It's fantastic. Actually, let me see something real quick. Like these guys I talked to yesterday, same thing. Anyway, the point where I'm going with this is retiring. It doesn't mean the stress will go away, but it can, be helpful in that regard. But one thing the biggest stress that you have is if you're heavy in stocks in the portfolio and you don't need to be. So like these people here today, we went from growth to more conservative. So growth is 70-30, kind of like we're going from that to like a Wellesley fund. Essentially, I said, man, just buy some CDs, dudes. He just moved some money from an investment to money market at Fidelity's like 4.5, 4.25, something like that. I said, man. So we reduced the risk. It didn't drop much off from their probability of success. They're still in the mid 80s, which freaking is the spot. That's where you want to be, man. That's the red zone. That's where you want to be, the mid 80s. Because if you're below 80, that means you're spending too much. If you're above 80, or above 90, you're not spending enough. So we want to be in the mid 80s. That's where they were. So they went from a growth-oriented portfolio under the platform with 87% probability of success and leaving a bunch of money downstream to a conservative portfolio and went to 83% probability of success but leaving less money. It didn't matter. They're like, yeah, but we don't have to worry about the risk. And I shared them the downside risk. The growth-oriented portfolio with I want to say 15% standard deviation. I can't remember, something like that. Versus the more conservative portfolio with a standard deviation like half that. And off the top of my head, I can't remember. Just remember, a standard deviation is simply the variance around the mean, a variance around the average. So if you have an average of 10, we have this variance. Sometimes you're at 8, sometimes you're at 12, sometimes you're at 20, sometimes you're like this, not the other. And so they take the square root of the variance around it, and that gives you your standard deviation. And what that means is within 1, 2, and 3 standard deviations, within one standard deviation around the mean, so you got the mean, the deviation beyond the mean. So we could go over here, we could go over there. On the down, on the up. You see what I'm saying? Within one standard deviation, that's a 2/3% of the time we expect the numbers to fall within one standard deviation. I think it's 95% within 2, we expect the numbers to fall within 2 standard deviations around the mean, the average. 3 standard deviations is what you really should use, and most Monte Carlo, I think, maybe some use 2. I'm not sure I like the 2, I like the 3. It means with a 99.8% probability, you'll fall within the 3 standard deviations around the mean. The mean is, again, the average rate of return. Now, there's always fat tails, there's always things that happen, but at the end of the day, it's a pretty good probability. It's a way to judge risk. It's not perfect. There's no perfect way to do this because we don't know what the future holds, man. Anyway, so when you're taking risk off the table, especially right when you're about to retire, in these guys' case, I just said, man, you're not running out of money. You know what I'm saying? I mean, and then you factor in social, when they got Social Security, and he did an annuity a couple years ago. They're gonna have this is a couple years, like 10 years from now. Because that's right. It's gonna be 7 years from now. When he's 70 years old, he's gonna take his Social Security. So between he and his wife and an annuity, they're gonna have like $100,000 of guaranteed income. It's like, why burden yourself with risk if you don't need to? If that makes sense. And I said, even if you quote ran out of money, you're still sitting on $100,000, dude. I mean, come on. Nuts. Anyway, and so I was talking to these people yesterday, and we reduced their risk. And instead of going from 87 to 83, it actually went up. It went from like 72 to 83 because we reduced the downside risk. I cannot stress enough, man. Retirement, why would you sit there in retirement and watch what has happened? You're not going to, people, it always comes back. Dude, I hate hearing that crap because you don't know that. In part two, look at this. So the markets are down. Let's look at the S&P 500. 1 second. The S&P 500 is down 1 month's time from 41. There we go. From February, it was up at 4,100, 4,179, and now it's down to 3,800. So it's down 300 points basically in a month's time. So that's not a huge loss. That's still 7.5% a month's time. Man, that's pretty big in a month, man. I mean, what's the likelihood of that? And I mean, I don't know. That's pretty big, especially after on top of that, this would be called a dead cat bounce, by the way. So let me show you what I'm talking about. See how it fell and then it came up, and then it fell and then it came up. That would be called a dead cat bounce. It's right back down again. Those are called dead cat bounces. I don't know why. You drop a cat off the Empire State Building, and it's going to bounce when it hits the ground. So it's basically saying, even though it's going towards the ground, it's bouncing like a dead cat. Yeah, kind of weird. Wall Street is very weird. The shenanigans of Wall Street, like friggin', we got straddles, we got straps, we got friggin' all kinds of crazy names. Spreads, straddles, is it straps? I can't remember. I can't. It's been so long since I've been involved in that stuff. I can't remember. But anyway. And then it got dead cat bounces. And what the hell is this? It's nuts. Anyway, why would you want to go into retirement and worry about this? I mean, I just don't know, man. Let's take a look at what Wellesley Fund did today. VWELX. That's Wellington. Excuse me. VWinks. So Wellesley was actually up today. Really? Well, if that's true. Well, that might not be true. Well, it says up 0.29%. I guess so, man. It says it. I don't know that to be true. But anyway, Wellesley, on the other hand, if you look at not nearly as volatile as the chart that is misleading. You got to look at the numbers over here. Not nearly as volatile as the S&P 500. So Wellesley was at 25.35 at the beginning of February, and now it's at 24. 25.35 minus 24.24 divided by, what did I say, 25.35? Wellesley is down 4.3%. That's more than I would have thought, actually, with bonds, because the interest rates, actually, I don't know. I think the interest rate, see, it says Wellesley's up today. I don't know that to be true. But either way, the Wellesley is a little bit less than half a little bit more than half the risk of the S&P 500. And I'm not saying you go out and buy Wellesley. What I'm saying is I was telling these guys yesterday, what I was talking about, who went from, I think it was 72 to 83% probability of success. I said, man, buy a whole bunch of CDs. I mean, you're getting 4.5%, dude, with no downside risk at all. None. So what's happening to Wellesley? What's happening to S&P 500? It didn't happen in CDs. Such a wonderful time to be conservative. The best time to be conservative that we've had in 20 years. Man, it'll reduce your stress. You're not sacrificing a whole lot. You're missing opportunity cost if the market goes up. Yeah, if the market goes up. Do you need the market to go up? Anyway, it's never been a better time to be an investor on a conservative side, literally for 20 years. Take advantage of it while you can, because we don't know how long it's going to last. Interest rates are dropping. I got a feeling it might not last long. Love to your thoughts. We'll see you.